Hi, I'm Chris Nelson, Senior Portfolio Manager and Head of Sustainable Investing at Russell Investments. This is Market Week in Review. This week, I'm going to focus on three things: the renewed rise in oil prices, the first signals from large cap technology earnings, and the return of tariff headlines. Let's begin with the major market moves. Broad equity markets have changed relatively little since our last update, but beneath the surface, there has been considerable action. The price of oil is back above $100 a barrel. Energy companies and refiners have advanced. Airlines, software companies, and some of the largest tech stocks have come under pressure. Semiconductor stocks, which have been huge beneficiaries of AI-driven compute demand, have been particularly volatile. The group moved sharply in both directions during the week, but remained higher overall. By Thursday's close, however, broader technology and communication services stocks had turned decisively lower, weighed down by Alphabet. The most immediate source of pressure on the markets is energy. Brent crude moved back above $100 a barrel as fighting resumed around the Strait of Hormuz. This has been compounded by new Ukrainian attacks on Russian energy infrastructure and ships in the Black Sea. Oil's quick return to these price levels has already pushed average U.S. gasoline prices above $4 a gallon during the summer driving season. But so far, markets have largely treated the geopolitical shock as sector-specific rather than systemic. Energy producers and refiners have benefited, while airlines and other fuel-intensive businesses have faced pressure. The open issue is whether higher energy prices begin to outweigh the strong corporate earnings by affecting household spending, corporate margins, inflation, and ultimately interest rates. The rise in the 10-year Treasury yield this week suggests investors are beginning to account for at least some of that inflation risk. That brings us to earnings, where the first reports from large tech companies are testing another important market assumption. Investors have widely anticipated that hyperscalers like Amazon, Microsoft, and Google parent Alphabet will need to expand capacity to meet AI compute demand. However, the question has been, how much can companies spend before investors begin demanding clear financial returns? In short, the market is wary. Alphabet reported revenue growth of 24%, but free cash flow turned negative on those higher cap spending plans, and the shares declined after market and today, reflecting concern about the scale and the timing of their spending. Tesla presented a similar tension. Revenue from its core automotive business increased, but higher capital expenditures pushed free cash flow into negative territory for the first time in more than 2 years. Tesla plans to spend meaningfully on factory redesigns and expansions as it pivots toward autonomous vehicles and robotics. High capital spending projections were widely expected, but what may be changing is the market's willingness to look through the near-term cash costs. And on tariffs, they're back. Following a period of relative trade normalization, the White House announced a new 50% tariff on a broad range of Canadian imports on Monday. The headline is significant, but the actual scope appears lower. The products included represent only 5% of goods imported from Canada last year. Overall, the announced tariffs would increase the U.S. tariff rate by only about 0.3 percentage points. And these tariffs could still be avoided or lowered through negotiation. That's not all, though. We may hear more on tariffs as early as tomorrow, as some are set to expire on Friday, July 24th. In February, President Trump imposed a temporary 10% global tariff to replace those that were struck down by the Supreme Court. That tariff is legally limited to 150 days. The administration has been somewhat guarded about what comes next, but U.S. Trade Representative Greer has suggested that the administration could impose the 10% tariff again, since there's no rule preventing that, or introduce a new set of duties. Regardless, any announcement would likely set off another round of negotiations, but the market response may be more contained than it was during earlier tariff episodes. Investors have become more accustomed to tariff volatility. Stepping back, the common thread across these three stories is the cost of investment and disruption. Higher oil prices raise costs across the economy. AI investment is testing how much spending investors will tolerate before demanding returns. And tariffs can alter costs and business plans even when their aggregate economic impact is limited. For markets, what matters is whether these pressures begin to change corporate outlooks, consumer behavior, and the earnings expectations that have supported the markets so far. Thanks for watching. We'll see you again next week.
Hi, I'm Sophie Antal-Gibert, Head of Portfolio and Business Consulting at Russell Investments. If you liked what you just saw and heard, consider subscribing to our YouTube channel or check us out on LinkedIn. Thanks for tuning in.